At the same time, we don't want customers to exit because these are long-term products.
One will also have to look at the interest rates that are being offered.
People don't buy policies to surrender it immediately.
Just before we start conversation, after 2 minutes will be all yours. Just to give a perspective, where are we when it comes to insurance? And I'm just quoting from, which is, I think all of you know, is pretty credible, or probably the most credible thing, the Swiss Re Sigma report. Where do we, life insurance penetration in India actually came down from 3.2% from 3.2% in FY 2020 to 3% in FY 23. So overall insurance, both life and non-life, is about 4% in 23. Global premium values, I'm talking about what are the stacking order. US 3 trillion, China very distant second, 698 billion, UK third, 663 billion, Japan fourth, 338 billion, France fifth, 261 billion. Where does India stand there? 131 billion. This is all numbers of FY22, and India's share is 1.9% in the global insurance premium. But that's not a very good story. But the good story is the commentary that Swiss Re has done, and you can get all this thing on the IRDA website, I guess. India from 10th is projected to be 6th by 2032. And it's the fastest growing insurance market. And it has given 6 reasons for this growing fast. One is strong economic growth. Second is rising disposable income. Third is young population. Fourth is increasing risk awareness among us. Fifth is digital penetration. And finally, I mean, I'm sure you'll agree this, the regulatory development. We have a very, very active, if I may say so, you might find him aggressive regulator. He's not yet in. He's on his way, so you can be frank about him till he comes. So first thing, let me start, is this, Biva, yes. Let me start with the pain point. Not the penetration, etc., but this surrender charges, which already took effect. It's good for us, those who want to be insured or insured, but not so good for your balance sheet. It's pretty old, but I understand that you still in private grudge about it. I mean, you're not very happy. So what's happening there? All of you can tell us.
Yeah, so thank you for having us here, Business Standard. On surrender charges, just more broadly, I think the regulator quite rightly is moving more and more towards customer-friendly solutions. And I do believe while there is immediate pain, it will go a long way towards increasing the pie. We saw this time and again. We saw this with unit-linked regulations in 2010, and thereafter many other regulations. And if I were to compare India versus some of the other countries in the region, we are the most customer-friendly products that are available today, one of the most transparent. Let me take the example of unit-linked. Unit-linked as in terms of charges, our closest large neighbor is almost 3x in terms of value extraction. Par versus the 90-10 rule, they are 70-30. So a shareholder makes 3x on a par product, and so on and so forth. Surrender charges are a lot higher. If I were to look at term rates, India is still one of the cheapest per 1 crore of sum assured, even versus some of the Nordic countries. So we are in a good place as far as overall what are we trying to solve for, insurance for all by 2047. Now let's talk about the pain. The pain is there, and little bit of also disconnect in terms of what is it that as insurers we were trying to do, because we're giving very long-term guaranteed products. So having an exit early on could potentially lead to an ALM mismatch, especially if interest rates move very sharply. But I think that is now history. When we look at the bigger picture, it is pro-customer, wherein at the end of first year, a customer gets a much larger amount than zero, and so on, at each increasing exit as an option. At the same time, we don't want customers to exit because these are long-term products. So we'll see how it evolves. I think I'm very proud of our sector that time and again, when we've had these large-scale regulatory changes, or even COVID, we have come out only stronger. So these are all growth pangs in my view.
Sure. Mahesh, just your two beats. There is pain as far as balance sheet is concerned, your bottom line, and also the asset liability mismatches that she's talking about.
Yeah. So I think before I get into surrender value, let's understand where this whole thing came from. Please understand that we are the only sector probably which promises a guaranteed return on money which you have not even given me today. Because when we collect 10 premiums in a non-par product and tell a customer we will give you an IRR of, let's say, 6%, I'm giving it to you on the basis of just one premium that you have given it to me. No? So obviously this was done because we hedged our portfolios, we took FRAs and we took positions in the market in terms of interest rates. And obviously when such a contract is getting unwound, there is bound to be mismatch in terms of the cost of the unwind, right? Having said that, I think we are pretty happy that finally customers are going to get a higher return on the surrender when they come in for the first year. It does cause some short-term pain, but as Vibha said, I think we're all beyond that now. What have we done to make sure that the pain is absorbed by us, right? First and foremost, we had to rework some of our commission structures with our partners in terms of deferring the commission or looking at a clawback in commission, etc. All of us have done that for various parts of our distribution. We're also looking at absorbing some of it as margins in the business. And thereafter, I think one will also have to look at the interest rates that are being offered, right? Right now, none of us have changed interest rates based on that. Interest rate changes have happened because of the 30-year and 10-year going down. But some point of time, I think we might have to look at the interest rates as well as an industry. I think by making sure that we press 2-3 levers, I think we should be able to absorb this and thereafter make sure that the customers feel more reassured with insurance as a sector and they feel far more confident about purchasing policies. And in the long term, we believe that it will only increase demand. 2014 surrender values went up in the industry, right? And I don't think we have had any negative impact because of that. So I think it's a long story. One more chapter is opening, and I'm sure the story will look good.
You know, the difference is this: a decade back, life insurance companies are not listed. Now they are all. So it's a different that you have to fend for your investors also.
I'll just have a comment here. Kotak Life Insurance is not listed, but we have the same obligation to our shareholders, customers, stakeholders as any other listed entity.
Okay, let's hear Bakshi sir, to banker turned insurance boss now. So tell us, what is your take?
No, so principally on the surrender value, last December, before the regulations came out, we had already come out with a product which had zero surrender charges. So last year itself.
So you started marketing even before, in the first
Not
round
marketing,
itself,
we came out with a product in
marketing
last December which had zero surrender charges. But to do that, you have to level the commission because you can't have upfront commission, otherwise you'll have other issues. And I also believe, and that is also, I think, borne out by the customer behavior everywhere across all the three of us, that people don't buy to surrender. People don't buy policies to surrender it immediately. The issue about surrender is that, what is the whole issue? Do you have a temporary liquidity issue or you have a permanent liquidity issue? If you have a temporary liquidity issue, all of us, we offer loan against policies, which are quite instant and quite easy. And if you have a permanent liquidity issue, that is where the issue could be, that if you have a permanent liquidity and you surrender, what is it that you get out? And you shouldn't lose too much money on that. There should be some penalty because it's a locked up product, but you shouldn't lose too much money. How much money is the penalty is a subject matter of discussion. I think that has got sorted out in the circular. If we look at equivalent products are NPS, there is zero liquidity, irrespective of surrender charges. You just cannot put. If you look at EPFO, so anything which is long-term corpus building does not have liquidity and has exist only at few points of your life stages. So if you're getting married or house, or there are 4 or 5 places where you can take the liquidity out. So actually there are no long precedences where you are building corpus as against building corpus for consumption where you have too much liquidity. So one should not, in life insurance, I believe one should not encourage that this gets into the liquidity mode. Having said that, there is a case where if there is a permanent liquidity requirement, the cost should be low. And all of us are mitigating it through deferred commission, clawback of commissions, and all of it. And I think, like many other cases, like in ULIP, like Vibha mentioned earlier in the ULIP, it will all settle down. Little bit we are all trying to protect the customers, and all of us, by and large, the industry has taken a stance that we are going to protect the customers. And between the channel partners and the shareholders, we will adjust, and some part also, efficiency will also, in some way, fund it. So I think it is okay. I don't think we should sort of get anything which increases trust in a sector is only good for the sector. I have seen it in mutual funds. I have seen it in banking. I have seen it in earlier avatar of capital markets. Anything which increases trust is good. And anything which changes the status quo is painful in the short run. Both are true.
Thank you. So you have seen banking, you have seen mutual fund, and you have seen now insurance. Now tell us, it's very, you may find it a very stupid question. Is this that we all know that insurance need to grow, industry need to grow, in kind of thing and all. But the intermediation part, and I'll start with you. Like I will do phone banking. We can invest stocks just through everything. But when it comes to insurance, it's just the agency driven. I mean, until using the, I'm not getting into the insure tech and all the other thing, but where is the use of technology to reach out to us to make it big, which in the equity markets, in banking, everywhere saying, but insurance is the same old stuff. What's happening? LIC is completely driven by agency, and you guys also too, most of you. Since you have seen all the three, just both the equity markets, now insurance, and of course banking. Just tell us, where are we in this intermediation part? And
no, so we will put in, I think it's a very, very sort of important point you are raising. If we were to break it up into two codes, there are products which are very liquid. Like bank FD is a very liquid product, mutual funds are very liquid products. And they're also very simple to understand. So anything which is simple to understand, anything which is very liquid, people do have courage also to invest because they can exit fast. And also they can understand because it is very simple. If you look at life insurance or any other products of locked up nature, because ours is a locked up nature, you will see either world over globally, that either it is mandated by government, like EPFO, like NPS, these are all largely mandated by government, because there is no normal method by which a person will get into an illiquid product. And also, I must also admit that because it is illiquid and the nature of the product, it is also complex. I think one of the things that industry has to do is to reduce the complexity. We have to reduce the complexity. But because of the illiquidity, it is slightly tougher to sell. It's not a natural buy. You will see protection, which is fully liquid. Protection is fully liquid because till the time you pay premium, you get a cover. You can stop premium. You will just stop getting the cover. You will see that in protection, there is some pool which is coming from the market, automated. And you will see that large part of the protection also is being done through the proprietary sales force or direct channels. So it is in the nature of the product that we have to put it in context. What we have to do as an industry, we have to further simplify it. And all of us are working on claims, so that also increases trust. And we have to figure out that, how do you make the processes very smooth? Because if you make the process smooth, demand also generates if you make a smooth process. So there are things which we have to do. There are things which has product characteristics issue. So what are we doing on the tech? I believe that on the tech side, on the ops side, I think we are using tech reasonably well. On the ops side, what we are not doing is, and we have to do more, I would say, is to simplify the processes even further. And we have to make it almost as instant as possible. ICICI Prudential, for example, on the saving side, almost 50% of the policies we are issuing same day, and we are giving commissions to the top advisors same day. No other industry that I know of gives commission the same day. So we have been able to do it. So I think it is possible to do it, and it increases trust of the intermediary. Intermediary is an important part of the industry. You cannot take intermediary out of any industry because it is also an issue of cost structure. And if you were to talk about banks or mutual funds, if you look at the cost structure over the life cycle of a policy, the cost structure of life insurance is quite competitive. If you look at the full life cycle. And you can compute it on cost by assets of the banks or total cost by assets of mutual fund, and you will see that it's quite comparable. It's the locked up nature which creates an issue.
Mahesh?
No, I think first, again, let's understand the category, This insurance category is probably forcing people to think long term. I would always say that if you're looking at short term, don't look at the insurance sector. It is like telling you to wake up every morning and lead a healthy lifestyle so that you can live up to 80, right? We are not in the instant gratification game, no? And today, unfortunately, the markets, the way they have behaved, I think there's a lot of interest in what you see as give and get and immediate gratification, whether it is FNOs, whether it is equity markets, etc. We're the only person who goes and sells a customer, look here, I want you to invest for 10 years. At the end of 15th year or 20th year, you will take care of yourself. So by nature, this conversation is a complicated conversation. It's not an easy conversation which says, okay, you'll make 20% return next year or you can pull out your money whenever you want. So that is why it's a consultative selling, advisory selling, and which is why it is still largely face-to-face. Pure term today is migrating more towards D2C or what we call direct to customer. Every other product is a consultative advisory selling where we are actually sitting with the customer, looking at bespoke requirements of the customer and structuring a policy for his requirement, right? So therefore, given the nature of face-to-face selling, it is bound to be phygital, as I would say. And I don't think globally also we have seen life insurance migrate into a completely digital platform. Non-life insurance, by virtue of its simplicity, where you pay a premium, if something happens, you get the sum assured, is easy to migrate.
Car,
right?
insuring our car, or
Yes.
which is on screen, we can
Correct.
do always.
So when I'm selling a 15-year product, 20-year product, when I'm selling an annuity, it's purely long-term, and therefore it requires consultative selling, which is why you have banks on one side, bank assurance, which is a major distribution channel for the industry, and secondly, the retail agency, which is basically another distribution channel, right? As far as digitization goes, I think Anup spoke about our front-end digitization. Increasingly, I think what we are looking forward to is on the underwriting space, using data analytics, using a lot of artificial intelligence, etc. Facial recognition, we are working with our reinsurers. Can I click a photograph of Tamalda and say how healthy he is, right? Can I do underwriting based on facial recognitions? Can we get data across the stream of morbidity and mortality together in one place where we are able to underwrite swifter and faster? I think those innovations will probably happen in this phase. COVID pushed all of us towards digitization of our processes for policy issuance, which worked brilliantly. For 2 years, we ran companies sitting at our home, and every claim was paid and every policy was issued. I think in this space, you will see this happening over the next 2-3 years. Maybe our underwriting processes will become even more data-driven, AI-driven, human intervention-less underwriting process, which will lead to probably better customer experience.
Viva, you want to add anything?
No, I completely agree with my co-panelists that during COVID, if 60,000 crores of claims were paid without anyone coming in person, surely we've reached some level of digital maturity. I'm also of the view that there's a lot happening, like Anup said, behind the scenes on many of our other processes, AI, ML, facial recognition, Meditech, cloud, using various apps, API integrations, and so on, voice recognition. Might not be as visible. I'm also of the school of thought that Mahesh mentioned that I would rather that a potential policyholder takes a little bit of time, maybe an hour on a weekend, to think through, because it is bespoke, that I have 2 kids, my spouse is not earning, or I have aged parents to look after. Each one's situation and requirements vary. So this is not a fixed deposit. This is not, I just invest in, or a car insurance. So I think this kind of instant technology augurs better for those kind of products, but that's not to say we don't have that technology, we do. But I think a phygital model is here to stay and is here to stay worldwide as well, and nothing wrong with it. But right now we have instant claims, instant servicing, frictionless onboarding, and so on. And I think we can get better at that. We can get better, for example, a family view. So these are all the things that I'm sure all my colleagues and at HDFC Life that we are trying to solve for, on how to reduce friction, how to ask lesser questions. But that doesn't mean that we will do away with intermediaries. So the phygital process, I think, is a more evolved process that can be a bespoke solution provider.
You spoke about data, and then everybody is now, you remember the incident which happened about 2 weeks back on the media headlines. It hit that one particular insurance company, the data leakage being sold and all. So how secured? I mean, all of us now would think twice, thrice before actually buying an insurance cover, because it looks like that data is compromised. So how do you react to that?
Well, first, let me say that honestly, in the insurance sector, we are still scratching at the tip of the iceberg on our use of data. There's so much more that we can all do with data. Let me give you an example, for instance. I'm underwriting the mortality of a particular individual. If there is data available which gives me track record of his accidents, whether he's had any road accidents in terms of his driving behavior, if I know whether he's been hospitalized before or not, right? If he's had no claim, etc. Just look at my ability to detect frauds and ability to actually offer a very, very customized insurance policy which may be absolutely apt for him. So today, I don't think we are using data effectively in the industry. I think IIB is working at it, and all of us need to start looking at publishing an insurance score. If you can have a credit score for a customer, why can't there be an insurance score for an individual? And if my insurance score is worse than Anup's, maybe he deserves a better premium than me,
yes.
right? So all this, I think, is the potential of data analytics, fraud detection, instant policy issuance, better underwriting, etc. But having said that, we are in the era of consistent watch over cyber attacks and cyber thefts. This is all pervading all industries, whether it is airlines, whether it is banking, whether it is insurance companies, etc. So this is something that is happening around us in the ecosystem, and all of us have to fortify our systems, take data seriously, take our purging policies seriously, take our file transfer protocols seriously, look at our VAPT and vulnerabilities extremely seriously. And I think all these incidents only keep on highlighting the need to do more. But I don't think there's anything specific happening in the insurance sector which is different from what's happening in the larger industry. But having said that, I think the fact that data is going to become more and more valuable to us and to the consumer, and the DPDP Act, etc., coming in, I think the level of investments, consciousness, and the commitment to make sure that data is secure and data is managed effectively is very important. I don't think there's any other choice but to use data effectively and secure it effectively.
All of you want to add something?
Yeah, so on the data side, it is a critical area, but again, life insurance, as different from banking and capital markets, it's not a high frequency business, it's a low frequency business first. So from that perspective, your surface area by which the attack can come also is lower, number one. Number two, on the banking and mutual fund side, actually your net worth can be taken out. Here, you can only take the PII. So you can take the information out. You can also take money and net worth out. Here you can take the information out. You cannot take the money out. Anyway, you are accusing that policies are all illiquid. So, there is no question of anybody stealing and taking any money from us in any case. And anyway, they will come under surrender value then, as you're mentioning. So you cannot take net worth out, and that makes it very different. But we have to be careful because we may have health records. And health record is very sensitive. PII is very sensitive, health records even more so. And IITA now is also, pushing and nudging all of us to really up our game on cyber security. I think it is very critical, again, from a trust factor, that the trust must increase, and incidents like this, lesser it is, always better. But these incidents have been there in banking, these incidents have been there elsewhere also. Of course, there was an unfortunate incident that we saw 2 weeks back.
Biva, you want to add anything, or we can shift to, yeah. Please.
Yeah. I think we are at a stage amongst, in the life insurance sector that we are aware and responsible as a sector especially on health records. So while we want to, your earlier question on technology, and we want to try out many things, maybe we want to try out on Meditech and so on, but containerization of those health records, purging, I think we do take it fairly responsibly. Also, many of us are part of other large financial services groups. So apart from what we do suo moto, but also overall, as part of the larger financial group, there are many other restrictions and responsibilities that are enforced on us. Plus, our regulator of late has also upped the ante in terms of requirements from all the regulated entities to look at many of these safeguards so that customer data is not compromised in any manner.
Just talking about data, just two follow-up questions. One is this, insurance is all about mortality and probability. Like life insurance is all about that. When I will die and how long I live. These are the two sides of the same coin. So one of the key factors for your risk management and underwriting is the mortality table. Okay, correct me if I'm wrong. My understanding is the mortality table, which is prepared by IALM, Indian Assured Lives Mortality Table, this called, is a decade old. 2014 last time it was revised. So how will you price the risk? I mean, aren't you taking it up with the regulator, the government? I mean, you are working on the mortality table, which is a 10-year-old thing.
So I can start off.
You are talking about data, you are talking about the real-time transaction. How scientific would be your risk management and underwriting capability if the basic data, mortality data in India is 1 decade old?
So most of us have been around for 2 decades, if not longer. And so we have our own data and experience at a very sharply defined on a cohort basis. So the starting point would have been, like you said, IALM. But since then, we have built our own data analysis at a very, very granular level. So if you see a decision tree on geography-wise, on various kinds of profession-wise, on age-wise, on COVID survivors, for example, those who have been mortality of people who have been hospitalized during COVID, we ourselves have that experience, and each one of us has that experience. So we do build our own hypothesis in terms of where we think this is going to get to, and the pricing absolutely has to take that into account. The most dangerous part is that if we ignore the kind of data that is staring at you and say, no, but going forward I'm going to get better, without any reason why you want to believe that it's going to get better. At the same time, what are the trade-offs? Because mortality, most of us have family members who are now in middle class, comfortably living above 80. At the same time, there is lifestyle stress. So nuances like that. Another very useful source is reinsurers. All of us do regularly engage with reinsurers to say, what are you seeing in other parts of the world? So which way are the winds blowing on mortality at a very defined cohort level? And that's how you build it. The proof of the pudding finally is on your embedded value, what's your operating variance on mortality? That's the only version of truth, because that says that versus my assumptions, this is what I'm trending at. And if that's a positive, largely a positive, then you know that your pricing is more or less right.
Anup, I mean, she is saying that is not a handicap because you guys are doing your own work and analysis. It's fine. I mean, so the industry is working on a 10-year-old mortality table.
So first I would just want to, Tamanda, I would just want to put it in context as to what is the leverage of the life insurance industry. When you have PMJJY where you get 2 lakh of cover on 416 odd rupees, you're talking of 500 rupees. For every rupee that you put, you get a cover of 500.
That's the kind of leverage.
That's the kind of
500
leverage.
times leverage.
Even for normal retail, for 25,000 you get a crore of cover. That is 400 times cover. And mind you, this is without collateral. It is not like banking where the leverage is 5 or 6 or 7.
Yeah.
And large part of it has collateral. So here there is no collateral.
Yeah.
And the leverage is 400. I don't think in general, whatever, I am the freshest in the sector. And when I speak to other people, I don't think people get it, that it is 400 times and 500 times. And in group term, which is employer-employee, it is 1,000 times. 1 rupee, you get 1,000 times of cover. So it is that much. Now, if we want to, the case for increasing coverage, which is the basic topic. Now, if you want to increase coverage, certainly all of us are large institutions, we have our own data. It is true. But if we see the inflection point of retail in Indian economy, it essentially came after Credit Bureau came and CRILC came. Those were the foundational methods by which really the credit started to come up, because it gives you pricing power, more accurate pricing. It also gives you a sense of where it is. And not just your data, the overall industry data, and you get to pick and choose the thing that you get. The other thing in our industry which is very peculiar is, with 1:400, 1:500, it is a great area for fraudsters to operate, because the capital required for frauding is very, very low. Is very low. It is very high in savings product, but very low in any risk product, particularly in insurance. So I would say that there is certainly a need, and it is working. There is certainly a need for IIB to be even more active and put that foundation even stronger. Put the foundation of fraud management stronger. So put the foundational elements. Use reinsurers very well, which Vibha said, because reinsurers have across the full industry data, is to use the reinsurers, and maybe regulations are also force in some way or nudge them to also share the data, because you are using the Indian data
Absolutely.
to take the Indian risk.
Absolutely.
So you must share the data back into IIB. And you even in the DPTP Act, the regulator can mandate, and it will not come under DPTP Act. So I think there is enough provision made and enough enablement for it to do it. IDA is certainly pushing IIB. IIB is also doing decent job, but I think we need to come off the curve much more. On the ILM table, you are right. It is currently 1214, which is working, which is a decade back. I think updated tables will come.
You have such a agile regulator. You are not asking him. You are a
No.
part of many
They are already
committees and all.
working, is what I understand. No, it's not a question. It's,
We'll
they're already
take
working.
Give you a
we'll,
perspective on-
Mahesh, just one. We'll take a few questions if you have any. No complaint, no grievance after this. Make it very brief and nothing about any particular.
Yeah, Mahesh,
entity.
over to you.
Mahesh, please carry
No,
on.
I'm just telling you, just to
get
give
the microphone there.
give you and the audience a perspective of the kind of data. A company like Kotak Life manages 5.1 crore lives, right? And I'm sure Vibha and Anup manage definitely more as well, right? So this is not small data, right? There is enough data that we have at our disposal, and those data cuts are examined right from demographics, geography, PIN codes, age, etc., to look at what pricing is, right? At the same time, as I've said before, I think honestly speaking, if there's one thing this industry can do better is our usage of data. Together, we can pool data the way banks, and I, again, former banker, 2007-8 was the inflection point in India when credit score-based lending happened. And today, as we stand 10 years later, one of the robust things which have happened in the banking industry is credit scores. I go back to the fact that insurance frauds and insurance credit scores are two very, very important critical success factors for the future of the industry. Coming to the ILM tables, we have been through COVID. I think it may be worthwhile to hit a refresh button and look at what happened during COVID, because COVID did two things. COVID resulted in accelerated mortality, right? Because what had happened was inferior lives passed away earlier compared to what they would have passed away because of the morbidity which hit them, right? So it may not be a bad idea now to refresh and go back and look at it, which I'm sure the regulator and the IIB will be looking at data so that we can have a 2025 version of how the mortality is going to look like, right? So that we're able to offer our products with more knowledge and more expertise.
Amalda, sorry.
Yeah, please add.
I want to use your platform to make an appeal.
Please.
And that is, we can significantly move the needle as a sector if, at least where subsidized hospitalization is given by the government, that Aadhaar is made compulsory. Once Aadhaar for any in-patient treatment is made compulsory, then a score can be built. Of course, there will be data protection. Of course, there will be customer consent or patient consent. But if somebody who's, say, in a small town tells me that even a Hubli kind of a place, who gives us the assurance that last 5 years I have not been hospitalized in any government hospital, especially slightly more disadvantaged society. That will give us as insurers a lot more comfort. Now, if NHS can do it, that you cannot get NHS treatment in the UK without your social security number. Like that, so I'm only talking about government hospitals.
Sure.
And I've said this to the government as well. It can help give us that data, of course tokenized, anonymized data, but give us something to hang our hat, like Anup mentioned, for giving credit.
Sure. I mean, till the time that credit score, etc., here, what would be the equivalent of credit score being built in the insurance sector? At least you need to have access to my health. I'll come to that. I have I think, interesting question on that. But before that, let's anybody? Yes, gentlemen. We'll come there. Yeah, please. Just make it very brief and introduce yourself. Yeah, mic is on, sir.
Good morning. My question is to all the panelists. Anybody can answer. I am Samir Kumar, an ex-banker and a corporate trainer. My question is with respect to unclaimed policies. I read somewhere that around 7 million policies are unclaimed, around 22,000 odd crores. What the insurance sector, nothing individually of any of the panelists, insurance sector as such, what are they doing to reach out to the families of such policy holders
Sure.
to settle those claims?
Thank you. Yeah, whoever wants to. Mahesh, you want to?
Thanks for the question. It's a topic which is on the mind of everybody these days, right?
Please.
So where does unclaimed come from? Let's understand first of all. It's coming from old policies where, unfortunately, we don't have current data about the customer in terms of the PII information. contactability data, and banking data. Otherwise, today all of us are remitting funds into the customer's bank account on surrenders and maturities. Since these are policies which had matured 10 years back it was taken, 15 years back it was taken, we are finding it difficult to have current data about the customer because he's moved on, changed his house, or didn't have a mobile number at that point of time. So customer contactability is at the root of this entire problem of unclaimed, and all this pertains to policies which were issued in the past. For the last 4 or 5 years, or even maybe even a little bit earlier than that, all of us today have very good information. Today, before we onboard a customer, we do an IMPS check in terms of doing a penny drop on his bank account, even before we issue a policy, right? Now, what are we doing about it? I can say proudly at Kotak Life, we are one of the lowest in the industry in terms of unclaimed, and we use social media. We have an entire team tracking customers across LinkedIn, across Facebook, across Instagram, to see whether the customer is leaving any footprint in the social media. We have gone to people's houses, we have gone to people's villages and inquired about their current contacts, etc. And that is what has been helping us in keeping the unclaimed amount at a fairly low level. So I think from an industry perspective, we are all conscious about it. We really want to give back the customer's money, right? As a customer-oriented organization, we don't want customers' money. It's his money.
Thanks.
He should rightfully take it back. But there are issues and constraints because of the past data, which is not currently valid.
Thanks, Mahesh. Yeah, just the gentleman, yeah, please give him you're coming.
Good morning, ladies and gentlemen. This is Mahesh Bhatt from Kirti Corp, independent software vendor and business consultant. Simple question, very vanilla flavor. In health insurance, we always find certain deduction happens once we submit a claim. Would like to extend this thought. In life insurance, if the claims are given, how much is 100% return? Whatever you commit, you give back to the so-called aggrieved
Thanks.
person.
Thank you.
And how much is cut? Ratio, proportion, some
Thank
indicators.
You. Yeah, Biba,
As of gross.
do you also...
There is no question of a cut.
Okay, thank you.
You have to pay whatever is the claim. So if there is a claim of 1 crore sum assured, then you have to pay 1 crore. If there is a fraud, then typically after 3 years, first of all, after 3 years, we in the normal course of our investigation, we cannot deny a claim. Before 3 years, we will be, if there is a fraud, then typically we would return the premiums and not pay the claim. And the individual or the beneficiary has the right to go to the ombudsman, and there's a due process to be followed if they feel that they are aggrieved.
Thanks,
Just to
Biba.
clarify, please understand, health indemnity products are indemnity products, indemnifying a customer up to a value of X amount. Whereas life insurance policies are fixed benefit products where it's a 0 or 1. If we settle a claim, we settle fully. In health insurance, the indemnity products, that's why you have a limit up to 5 lakhs, and therefore the deductions happen based on what the insurer sees as
Thanks,
the right
Mahesh.
amount to pay.
Yeah, this gentleman, please, quickly.
I'm Nagesh Alai from Avananta Innovations. It's a Gen AI startup. My question is this, even today, why is there a dissonance in terms of selling the product? Premium to me is a cost. Insurance is a cost, but it's always sold as an investment product. So why is it continuing that way? Even when the agents talk to you, they talk about it as an investment product.
Okay. I think Anup. Yeah.
No, I think there are broadly sort of 3 categories of product. One is a pure protection product where there is no savings, but because it has medical and other things involved, you know, there are certain category of advisors who don't offer or don't sell those products or offer that products that much to the customers. Then largely you will have all corpus building product, accumulation product, where you are paying for some time and the corpus accumulates. And you will see large number of advisors are into corpus building products. And third are deaccumulation products, where corpus is already built and then you have to convert it into income, which is annuity products. Now within corpus building products, you can have sort of what we call guaranteed products, or we have participating product where all the profits is sort of participated, 10% we keep, 90% we give. The fact of the matter is that you are right, that in India, as you know, Tamalda earlier said, the protection data and protection awareness is not that high, and on the younger categories where they require protection. Younger categories where they require protection, and as you age, you require more corpus. And that is where bulk of the advisors sort of focus on. But we are seeing the trend that the younger guys, they are coming more online and they are taking protection largely. So the demand is self-generated. On the other side, the demand is getting generated. So predominantly, you will see from an AUM perspective, you will see it is larger savings and investment, corpus building products, or deaccumulation products like annuity.
Thanks, Anup. I have many more questions, but unfortunately, we don't have much of a time. But one thing I want to ask each of you, yesterday, cyber crime, fraud, etc., dominated discussion in the second half of the day. Now, in insurance, I understand there's a fraud, it's happening, continuously been happening. Nothing to do with cyber crime, but it's very different thing. I'm talking about the path labs. Now, if I am giving you my reports, etc., in major metros or big towns and cities, etc., everything is fine. But I understand that in particularly in rural India, mofussil towns, etc., path labs is a big racket. What they have given the health checkup, etc., they're all rubbish. It's just always in the favor of things. So it's a very large-scale fraud. So in that context, and IRDA chairman is not here, so do you think there should be a health regulator separately? Otherwise, how do you tackle this? Mahesh, you are smiling.
No, I think
First, do you agree what I am saying? Is it my observation correct? And if it is correct, then how do you address it? Is the separate health regulator, which does not exist in India as of now? I don't know globally what happens. Just quickly, we don't have much of a time, but
no, India definitely is underserved in terms of number of the path labs. We have about 80,000 path labs. I think that number can definitely go up multiple times to cater to the growing demand of what you call testing and diagnostics by customers and insurance companies. Now, coming to health authority, I think that has been one of the biggest requests from the industry, saying that it's time we set up a health authority, only because the variance in the value of the treatment across the country is enormous. There has been huge amount of medical inflation hitting companies, hitting insurance companies, because of the fact that there is variance and there is also escalation in the costs, right? So the industry has been requesting for a national health authority, which can probably help bring in some amount of stability in the medical costs. As far as path labs are concerned, I think accreditation of path labs will definitely help, because there are frauds happening there. In fact, what I would like to have is probably biometric-based authentication at the path lab, because today implants or impersonation is a big problem that we face. X buys a policy, Y goes and actually does the testing, right? And we are unable to detect it. So I think if we can have a biometric-based network, which can also help the path labs, and we get data assurance that, look here, the right person has gone. And of course, the quality of path labs in terms of accreditation. Other countries have had this accreditation. Will it help? It will help. But today, is it such a big problem for us? I don't think it's such a big problem. But impersonation is something that we would like to control.
Thanks, Anup. IRDA chairman is here. Just for your information, what I asked him is this. We understand that path lab is a big racket in rural India. So they're not very credible reports, and it's actually amounts to a fraud. So should we have a health, some regulation, kind of health regulator or whatever you call it? I know this erodes your empire, IRDA empires. I don't know how frank they will be now. You have come. So he's listening. Anup sir, tell us.
No, I think it is.
I mean, you must be meeting at various fora and closed door meetings, so you're not scared.
It is about solving the issue at hand. I mean, whether A regulator does, B regulator does, whoever does is not the issue. The core issue is that certainly if there is any fraud that happens, in general the cost of the industry goes up, in general the trust of the industry goes down, so accreditation method is a very useful method, and fraud registry is a very useful method, because if you have fraud registry, then you avoid, and that's how the market also develops, that only to the good guys if you go, then you can have straight through processing. If you don't go to a accredited person, then there will be, other issues, or the prices will go up. Because the market also has to kick in addition to the support system of accreditation. Who does it is a subject matter of a larger debate. But this is a requirement.
Sure.
Because 1:400, 1:500 is the risk that we run.
The highly leveraged,
Highly leveraged. Because for 416 rupees, when you get 2 lakh of cover, it is 400 times, 500 times cover.
PMJG you're talking about.
So fraud is an important element to be curtailed.
Biva, quickly you want to add anything?
Yeah, both in terms of path labs and claims investigators, both ends. So this collusion, and like Anup said, the cost goes up for the honest policy holder and brings, the trust deficit that you will never pay the claim, because it is possible that the intermediary is colluding, not the end customer. And the family thinks that the person their loved one has adequate insurance, and we're denying the claim. We are in the business of paying the claim, not denying the claim. So if the ecosystem also behaves, then the cost of insurance can certainly come down. And that is important through IIB certainly, but also they mushroom. So if you blacklist one, they mushroom as something else through another set of people, the same guys. So this is a menace, and regulating in some manner, some method in all of this will bring down the cost.
Yeah,
and
I'm sure
trust.
regulator is listening. So we have just almost 20 seconds left. So just one 10 seconds each, you can say that. There are lots of interesting products, etc., happening in the general insurance. Priyanka Chopra insured her smile. Rajinikanth insured his voice. Okay. All kind of things. Even the wedding events are insured if some natural calamity or something happens that it get cancelled. So, is there anything happening in the life insurance sector when it comes to products? And one more on the adjacent thing. You can just have 2 sentences each, and we'll close that. Yesterday again, we for the first 2 days discussed that this mutual fund sahi hai. Then it comes to spills over to bank deposit sahi hai. So that's the kind of new approach to make it more awareness, creating awareness and all. Insurance, again, I was telling you, agent driven. So if I ask you to create a slogan which will be, every household will talk about that, what would be that for life insurance?
Insurance zaruri hai.
Okay. And the first insurance zaruri hai. And the first thing, any products, anything we can expect?
No, let me say that honestly speaking, between life insurance and general
Say for
insurance.
Kotak, it's a marketing platform. You can, or
Oh
each
yeah,
of you,
want
tell
me to
us that
say
this is
specifically,
something
we were
coming
the
up.
first company to launch a cover for the next generation. You buy a policy, Tamalda, right? You live till 60, right? Normally, you don't need term insurance beyond 60 because your earning years are almost over, right? So we return the premium to you, and in the same policy, we cover your child, right? Till up to 60. It's called Gen to Gen, generation to generation. We have launched this product a couple of months back. So that's an example of innovation.
Any unique product and a slogan?
Now, I think in general, we have to move towards simpler and simpler products, more complex and more unique products.
No slogan?
No, more slogan is this only.
Achha.
Slogan is this only.
Viva, last word is yours, and that's the end.
Yeah, on a lighter note, you said somebody insures somebody's smile. I think we insure somebody's sleep. That they can sleep well
Somebody's
at night.
sleep.
Yeah.
Achha.
So by buying life insurance in any form and pension, we are trying to ensure people's sleep.
Okay.
That you don't have to worry about things.
Okay. So don't sell it now, because I don't want people falling asleep when regulator is talking. Okay. Give them a big hand, and that's the end of our thing. Thank you.